This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Slowing to a crawl. Economic growth stalled at the start of the year as businesses slashed investment and exports tumbled. Insights from a former Fed governor about what's next.
Not yet. The Federal Reserve does not move on rates and left few clues about what might lie ahead.
And your money. What should you do with your stocks and bonds now that the Fed has spoken? All that and more tonight on Nightly Business Report for Wednesday, April 29th.
Good evening, everyone, and welcome. Anemic, that describes first quarter growth. And while many expected the economy to be weak, they didn't expect it to be this weak. Gross domestic product, the broadest measure of goods and services produced across the economy, grew at just 0.2%, a massive deceleration from the fourth quarter and much worse than expected. Federal Reserve policymakers also downgraded their assessment of the economy, leaving more questions about when the central bank will raise rates. We begin tonight with two reports. Hampton Pearson has more on the Federal Reserve statement, but we begin with Steve Leisman and the economy's slow start to the year.
The first quarter's weaker than expected GDP has ignited a debate on Wall Street and at the Federal Reserve over whether the economy is slowing more seriously or just working through some temporary setbacks. Severe winter weather in the east and port shutdowns in the west were the obvious temporary factors. But the negative effects of a stronger dollar and the decline in oil prices also played a role, and no one knows how long they will continue to hurt the economy. What we do know is that it was another weak first quarter in a string of them.
It's kind of a deja disaster. It's kind of like the same thing we saw last year. We came into the first release of GDP expecting growth of above 1%, and it came in effectively at zero. I do think that some of this is the normal volatility of the numbers, and we will get a bounce back.
Consumer spending hung in there with a nearly 2% gain after an even stronger rise in the fourth quarter. While economists believe lower oil prices and more jobs should prompt even higher consumer spending, it was not the main source of weakness. The biggest drag came from exports, which fell 7% and knocked a full percentage point off of growth. The strong dollar could be playing a role, making U.S. exports more expensive and hurting the overseas earnings of U.S. companies. Slowdowns in the ports and out west could also have played a role, keeping exports from leaving the country. Another major area of weakness, plunging investment in the oil and gas sector as a result of lower oil prices.
The minus 23 in structures is a big decline, and about, let's say about 15% of that will be related to CapEx in the energy sector. So the rig count drop in Q1 is certainly showing up there. We were tracking minus 11%, so that's about twice as large of a drop.
The good news, last year's sharp decline in the first quarter was followed by 5% growth in the second quarter. All Wall Street and economists can do now is wait and hope that GDP history repeats itself in 2015. For Nightly Business Report, I'm Steve Leisman.
The Federal Reserve wrapped up a two-day meeting by issuing a policy statement downgrading its assessment of the economy, citing slow growth during the winter months, a decline in consumer spending despite rising household incomes, softening business investment, and job gains moderating. Evidence some Fed watchers say there's no sign that a rate hike is imminent.
They want to hike rates, but they want to hike in the context of better data. Now they've seen two soft quarters in a row, including a zero quarter. To dig out of that hole, they need to see two solid numbers in a row. That means that September is the earliest they would go, and they could wait longer.
But Fed Chair Janet Yellen and her fellow monetary policymakers said most of the factors that contributed to the slowdown in the first quarter are transitory. It expects the job market to rebound and inflation to move back to the Fed's 2% target. Some Fed watchers say a June rate hike is not off the table if the economy rebounds in the second quarter.
They're willing to look through that weakness. They think it's oil, they think it's the dollar, and they think the economy is going to be stronger in the second and third quarter.
The latest bottom line from the Fed, depending on the economy, every future meeting of the FOMC should be considered live when it comes to the possibility of an interest rate hike. For Nightly Business Report, I'm Hampton Pearson at the Federal Reserve.
Randy Krosner joins us now for more analysis on the Fed and the economy. He's a former Fed governor, now professor of economics at the University of Chicago's Booth School of Business, and a frequent guest here on NBR. Welcome back, Randy. Good to see you. Do you see the economy the way Chair Yellen does, and that is that the first quarter was beset by transitory problems and that the economy will bounce, if not snap back, and that inflation will soon be moving back towards 2%?
So I don't think we're going to get nearly as much of a bounce back as we got last year. I think the economy will be coming back. We're going to do better, I think, in the second and third quarters than we did in the first. But I don't see the same snapback, because part of what happened in the first quarter is we didn't sell as much as we had expected, and so there's a lot more inventory. So probably businesses are going to produce a little bit less because they want to run down some of those inventories.
So, Randy, as you look at the Fed statement and assess it, what was the most significant either change or factor in today's announcement?
Well, it's interesting how they characterized the slower economy as in part transitory. That left them complete flexibility, because it said that some of it's transitory, so don't think that the rate hikes are off the table. But it's only in part, so it left open the possibility that, well, maybe some of these things could be lingering, like headwinds coming from the stronger dollar, and so we have to wait and see.
So as you look at the statement there and you do the sort of Kremlinology or the linguistic analysis of
Yes.
it, you see them really trying to leave it very open and maintain all of their flexibility so that they can move when they want to. But basically, isn't this a very accommodative Federal Reserve?
Well, I think certainly with a $4.5 trillion balance sheet, it is very accommodative. There's no doubt about that. But I think that the question is, when are they going to start pulling the punch bowl away a little bit? And I think there are a lot of different views around the table. And so Chair Yellen has to manage both the expectations in the markets about when they might move, but also satisfy the different members of the FOMC, some of whom want to move very soon, probably wanted to move earlier, and others who may not want to move until next year.
And when do you think that they should move or will move?
Well, I think inflation pressures are really not there. We saw that in the core personal consumption expenditure index. The price index from the GDP was less than 1%, was 0.09. That is probably the lowest than it's been since 2010. Wage pressures are not there yet. We have these uncertainties in the economy. So my guess is it's going to be a while before they would feel comfortable to move, probably towards the end of this year. But it's going to depend on the data, as always.
Well, very briefly, why do we need higher interest rates? Typically, when you raise interest rates, it's because either inflation is getting too hot or the economy is getting too hot, or both at the same time. Why do we need them now?
Well, the Fed wants to try to not be behind the curve, because the expectation is that at some point we'll start to see wage pressure, we'll start to see price pressure. We haven't seen that yet, and so the Fed wants to make sure that it's ready, that inflation doesn't get out of control or the economy doesn't overheat. But I think, exactly as you said, given where we are, I'm not sure that they're in a rush to raise rates.
All right. Randy, great as always to see you. Thank you very much. Randy Krosner with the University of Chicago's Booth School of Business.
And as our Steve Leisman reported a little bit earlier in the program, exports dropped sharply in the first quarter, even as a growing number of small businesses have started selling their goods overseas. And we'll have more on that part of the story later in the broadcast.
And Sue, to stocks now, which had a kind of choppy session following the release of that Federal Reserve statement. The Dow Jones Industrial Average was off as much as 156 points at one point during trading today. It closed 74 points lower at 18,035. The Nasdaq off 31 points. It was off about 1% earlier in the day, and the S&P 500 fell about 8. As for the bond market, yields whipsawed this afternoon, breaking back above 2%, as you see there.
Joe Duran joins us now to discuss what you should do with your money now that we've heard from the Fed. He is CEO of United Capital, a financial life management firm with about $13 billion under management. Welcome back, Joe. And I guess that is the question.
Thank you. It's good to be back.
What do you do with your money now that the Fed has taken all the calendar issues out of the particular statement that we heard today?
Well, the first thing you need to do is look at the overall risk of your portfolio. I think a lot of people have benefited a lot from this rising stock market, and they haven't looked at their overall risk. And I would suggest that we're entering a period here starting in May where we're going to have a lot more uncertainty, a lot more whipsawing. So make sure to look at the overall risk in your existing portfolio before you then assess where to invest.
It would seem to me that a lot of people have also benefited from a rising bond market over recent years, and that some of the risk in the portfolio of many individuals might well be in bonds. Do you agree or disagree?
I completely agree. It's the area with the biggest risk that most people, the average viewer and the average investor, is simply unaware of. They might go for an extra 1% in yield by buying a 30-year bond instead of a 10-year bond and be doubling or tripling their risk. So a 1% change in interest rates could be, instead of an 8% decline, a 20 or 22% decline. The risk right now on bonds is incredibly high. So we tell everyone that's where the real problems lie potentially for the market.
All right, so once you've assessed your risk or your exposure, as the case may be, what equity positions are you recommending right now? I see you're looking closely at Europe.
Yeah, so what we've seen in the dollar is actually that it's been weakening quite a lot against the euro. And what we're seeing, I think, is the commodity markets and the currency markets telling you that the Fed's going to do nothing until much later in the year than originally expected. And that means that you're going to have a lot more volatility and uncertainty. So what we think is you want to invest in those markets that haven't participated as much, Europe, emerging markets. And if we're going to have rising interest rates, you want to be in larger companies than smaller companies. So there's some names that we think are interesting if you have taken care of the risk of your portfolio.
All right, Joe, we'll leave it there. Thank you very much. Joe Duran with United Capital.
And still ahead, want to find the lowest price online? It's a simple question with a complicated answer, but Courtney Reagan's got it. The Securities and Exchange Commission has called for new rules on executive pay. The proposal would link compensation of top executives to the company's financial performance and require the disclosure of stock options and other benefits. The proposal passed by a vote of 3-2. It was mandated by the 2010 Dodd-Frank financial reform law.
Oil prices hit their highest level of the year today. Inventories at the large oil storage facility in Cushing, Oklahoma, saw its first stock drawdown in 5 months. And that suggests to some that the oil glut may be starting to ease. West Texas Intermediate crude rose 2.5% to $58.58.
The energy markets are also watching a shift in power in Saudi Arabia, the world's top oil-producing country. The moves come at a time of almost unprecedented regional turmoil and could have far-reaching implications. The changes announced by 79-year-old King Salman today follow a host of transformational moves that began in January, when he succeeded King Abdullah, who died at the age of 90. Saudi regime changes are watched closely in Washington and on Wall Street to see how they affect both the politics and the business of an evolving Saudi Arabia, not to mention the turbulent Middle East. King Salman put his 55-year-old nephew, Prince Mohammed bin Nayef, next in line to become king. He's the first of his generation to move one step from the throne. King Salman also moved his own son, 30-year-old Mohammed bin Salman, up to second in line. Bin Salman is Saudi Arabia's defense minister and has already assumed a high-profile role in the military campaign the country has waged in Yemen. He's also in charge of a key committee that oversees economic affairs. The moves come at a tricky time for Saudi Arabia and for U.S.-Saudi relations. The Sunni monarchy is keeping a close eye on its regional rival, Shiite-run Iran, and the regime, a longtime U.S. ally, is wary of any American rapprochement with Tehran. As for Saudi Arabia's critical industry, oil, the royal shakeup left it largely untouched. Longtime oil minister Ali al-Naimi kept his job, though he was replaced as chairman of the country's oil company, Saudi Aramco, by a well-known businessman. Few think the changes will affect Saudi oil production or the price of crude.
Oil is too important for the Saudi economy in a very fundamental way for it to be, a function of political games. And that's not going to change regardless of which individuals happen to be at the top at any given moment.
Oil aside, there are other issues at home that could destabilize the regime. Employment for a youthful population, nearly half of which is under 30, is one issue. Maintaining stable relations with conservative clerics is another. And yet a third is how moving younger men up in the line of succession will play with hundreds of older princes who could well feel shoved aside. And finally, the new king is being much more assertive and quicker to make decisions than his predecessors in reaction to global events.
MasterCard's profits rose double digits, and that's where we begin tonight's market focus. More consumers swiped, which helped the credit card company's bottom line, but revenue missed estimates. The CEO says consumers are spending less on gas and more on paying down their debt. Shares rose just a penny to settle at $90.24. Humana reported earnings today that fell below consensus. Revenue did rise 18% as the insurer's memberships continued to grow, and it reaffirmed its full-year outlook. Still, shares fell 7% to $168.05. Anthem also posted mixed results. Profits rose and topped estimates as Medicaid enrollments were up, but sales came in below the street's estimates. Shares were off 2% to $151.07. And Lumber Liquidators reported a surprise first-quarter loss. This as the flooring retailer faces possible criminal charges from the Department of Justice. The investigation centers on imports from China that allegedly contain a higher level of formaldehyde, a known carcinogen. Shares plunged 20% to $26.76.
Starwood Hotels may be looking to sell itself. The company hired the advisory firm Lazard to explore strategic alternatives, saying no option was off the table. Separately, the company beat on both the top and bottom lines in the latest quarter. Shares up 8% today to $87.52. Meantime, Salesforce Com is also apparently a possible takeover target. That, according to a report from Bloomberg. With a market value of almost $49 billion, there are only a few internet and software companies that are larger than this cloud computing firm. Shares spiked on the report, up 11% to $74.65. Shares of Twitter still tumbling after last night's disappointing report. Today, CEO Dick Costolo reacted to the less than ideal numbers, saying new products should help Twitter in the near future.
We had a slight miss on revenue. Anthony and I talked about that on the call. We've got a great revenue engine. It was due to our direct response business. Those products are new. They're less than a year old. We know what we need to do there, and I think we'll see improvement.
Twitter shares off 9% today to $38.49. And a big miss after the bell from Yelp. That's the site that lets people review businesses. It posted a loss, revenue missed estimates. Its outlook also disappointed, and that sent shares sharply lower initially after the report. You see it right there, falling off the cliff. During the regular trading session, though, the stock closed up fractionally at $51.29.
The easiest question shoppers can ask is, where can I find the lowest price? But the answer can be complicated. So Courtney Reagan and CNBC, along with personal finance website NerdWallet, teamed out to figure it out. Courtney, so how'd you conduct your research? What did you look at?
This is a very non-scientific study, but CNBC and personal finance website NerdWallet looked at 11 consumer electronic products at 5 retail websites every week for 12 weeks, and we compared the prices pre-shipping and pre-tax. So we're talking just base price here.
Mm-hmm.
So what did the nerds find?
And so
you excluded, of course.
Yeah, oh, right. And so what we found is that in this snapshot of time, this 12-week study, Best Buy and Target's prices were higher than Amazon and Walmart's prices. However, Walmart was out of stock the most often. Best Buy was out of stock only one time on one product in the final week. Costco was the 5th retailer, and that one was difficult because the products were not consistently listed on the site. Some weeks they were there, some weeks we
Were the
couldn't find
price
them.
differences large, material?
It depended. So on the TVs, you saw a pretty large price variation because that is a higher price point.
It's a
so
bigger
that makes
ticket
sense.
item, yeah.
But if you look at the Sony PlayStation 4 or the Nikon DSLR camera that we looked at, those prices were pretty consistent from week to week and retailer to retailer. And then the retailer's response to us, many of them said, look, we all have price matching policies and programs with the exception of Amazon. Amazon then pointed out, We have third-party sellers. We don't influence their prices, so we have lots of prices that you could be looking at. But all of this was publicly available information on the websites. We just really combed through it and very carefully looked at it.
So you could get a price match, but then you have to go through the whole process of trying to get the price match, right?
You
have to scan it, get the SKU, go to the retailer.
Or at least somehow prove to the retailer that you have found a lower price on an identical item within a close period of time. And that's going to vary from retailer to retailer, whether it's 7 days, a month, online, offline. It's a little different, but it doesn't hurt to ask, and certainly should do your research.
Excellent. Courtney, thanks so much.
Thank you.
Great job. All right, to read more about finding low prices online, head to our website, nbr.com. Coming up, how technology has helped small businesses do something they once thought was impossible: sell their goods overseas.
Here's a look at what to watch tomorrow. Dow Components, ExxonMobil, and Visa are out with their earnings. 2 economic reports will be released before the bell: jobless claims and personal income and spending. And take note of this, it's the last trading day of the month. That's what's on the agenda for tomorrow.
Ben Bernanke has a new job. The former chairman of the Federal Reserve has been hired by PIMCO as a senior advisor to that firm. Bernanke will provide guidance on PIMCO's investment process and meet with clients on occasion. A bit earlier this month, Bernanke joined hedge fund Citadel in an advisory role.
Another sobering survey on Americans' ability to save. According to Northwestern Mutual, 1/3 of those surveyed have no financial plan. 58% believe they need to improve their financial planning efforts. 43% haven't spoken to anybody about retirement planning. And 21% of Americans are not confident they will reach their financial goals.
More small businesses are able to do something they once thought would be impossible: export. And the decision to expand sales overseas has created a financial lifeline for some of them. Kate Rogers has more on the rise of the so-called micro multinationals.
Give me a little test here.
Exporting has brought Gelb Music, an institution in Redwood City, California since 1939, back from the brink. The brick and mortar took a stab at selling products overseas 7 years ago on eBay amidst construction and slowing growth. Sales started out small at around $250,000 in year one. Today, nearly 30% of its business comes from exports.
eBay saved the store. We had some slow times at the store. We had some construction going on. Sales had dipped. That's when we started putting a lot more products into eBay, and it really saved the store. We did about $750,000 that 1 year. And now with the global shipping program that's come about, now we can reach other areas of the world that we would never have reached in the first place. And the repeat customers too.
Having a global footprint may be a goal for many U.S. small businesses, but unfortunately for most, it's not a reality. Data from the International Trade Administration shows less than 5% of American small businesses are shipping their goods overseas. Now, e-commerce platforms are helping small businesses to expand their reach globally, breaking down exporting barriers like language differences and regulations, according to a new report from eBay. eBay finds that in 2014, 90% of the small and medium-sized businesses that sell on its site are exporting. More than 190,000 of the businesses reach consumers on 4 or more continents. In 2009, less than 30,000 were exporting to at least 15 country markets. Gelb Music now has customers all over the globe, with repeat customers in unlikely places, as far as the Middle East. eBay says 80% of its sellers now reach 5 or more markets. Small businesses once struggled to find customers overseas and ran the risk of not getting paid upon exporting, says Todd McCracken, president of the National Small Business Association.
With these e-commerce platforms like eBay, they've solved both of those at once. They're helping you find customers by using their net marketing channels, and they help assure you get paid by the tools they have.
Of course, eBay is hardly the only game in town. Other e-commerce platforms, including Amazon, Etsy, and Alibaba, all boast a global reach. However, the sites would not provide comparable exporter numbers. Given the reach of those 4 platforms alone, it's likely the small business exporting trend will continue. For Nightly Business Report, I'm Kate Rogers.
And to read more about how e-commerce companies are helping small businesses go global, head to our website, nbr.com.
And finally tonight, there was no take me out to the ball game today at Camden Yards. The Baltimore Orioles and the Chicago White Sox played to what is believed to be the first Major League Baseball game in front of a completely empty stadium. Fans were shut out of Camden Yards as a precaution following the unrest that broke out amid tensions between residents and police on Monday. The final score was 8-2 Orioles. The game was completed in a very brisk 2 hours.
You know, they did do today's attendance, you know, when they announced that at the top?
Did they?
Today's attendance is 0.
Is that right? No kidding.
They did. I read that on the news.
I could have guessed the attendance and maybe won a prize.
You could have.
0. All right.
So good to have us back together.
Yes, it is.
Isn't
Fun to be together.
All right. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll see you right back here tomorrow night.